Hi, I'm Miles Hutchinson. I'm one of the speakers for the Finance and Accounting for Non-Financial Managers course at the American Management Association. One of the topics that I'd like to share with you today is the break-even point analysis.
Break-even analysis determines the lowest amount of business activity necessary to prevent losses. At the break-even point, a company's net profit, also referred to as total profit or total sales, are equal to their total costs. If total sales or profit do not cover total costs, the company is operating at a loss.
This is a very powerful tool that management can use to help guide them in production volumes and activity levels. So one of the ways we can do that is we take a look at breaking down the income statement into its sales price, its variable costs, and its fixed costs.
Sales price. This is the price at which you will sell your product or service, so the price it would actually sell for in the store. Fixed costs. These are the costs that remain the same regardless of how much product is sold. This includes rent, insurance, utilities, etc. Variable costs. These are the costs that vary depending on how much product you sell, such as material costs, labor, etc. Total costs includes both your variable and fixed costs. So, total cost equals the sum of your variable costs and your fixed costs. There are two methods for calculating the break-even point: the equation method and the contribution margin method. So Miles is going to teach us the contribution margin method.
We do this sales price and the variable cost on a per unit basis. When we take the difference between the two, we can find the contribution margin that each unit that we make and sell will contribute to covering overhead and making a profit.
Contribution margin is the difference between sales price and variable costs. So that formula is break-even point equals fixed costs divided by contribution margin.
So if we take a Harley-Davidson Heritage Softail, typical price for the motorcycle of $30,000, a variable cost to produce it and ship it to the dealer of about $20,000, the contribution margin that each unit produces or contributes is $10,000.
So how do we calculate the break-even point?
If we have a target profit of zero and a total fixed cost of $1 million on a plant that produces Heritage Softail motorcycles, then we have enough information to figure out what volume of activity we must have in the way of production and sales in order to produce that target profit of zero.
Now that we've determined the unit contribution margin, how many Heritage Softails at $10,000 per unit will we have to sell to cover our $1 million of fixed cost? To find the break-even point, we need to divide the fixed cost by the contribution margin. So we have $1 million in fixed cost divided by 10,000 per unit contribution margin equals 100 Heritage Softails that need to be sold to break even.
It's just one of the topics in the Finance and Accounting for Non-Financial Managers course that you'll experience at the American Management Association.